Hey everyone, and welcome back to another video for today. So in today's video, I do want to cover four smaller companies that aren't expensive, have not been expensive before. They're just cheaper right now. They all reported their quarterly figures. Now, before talking about those companies, let's maybe talk about what's going on in the market right now. And what's going on with the market right now is a couple of things. One, a lot of the high-flying names, right? We're up 200, 300, 500, 600%. A lot of these names are unprofitable companies. A lot of these names might never be profitable in the future. Also, we still don't know what's going to happen. Rate cuts, no rate cuts in December, right? Previously, a month ago, that was 90% probability of a rate cut in December. Now that sits, 50-50 or maybe even in favor of no rate cuts. Why is that? Well, we had a government shutdown. Government shutdown has ended. Market didn't really react to it. We're also not getting a CPI report. We're not getting jobs data. And so maybe the Fed might not be able to make a decision. Although, is one report going to be the difference between them making the good or bad decision? I don't think so, but okay, that's beside the point. Last thing here, if we're not getting a cut in December because of the lack of the data for October, then we're probably anyways going to get a cut in January because you're going to get that other data from November and December. So I guess if they don't want to rush the decision, then they'll just have to wait 30 extra days. Then you also had, in my opinion, the catalyst was, of course, well, the podcast, right? Brad Gerstner, Sam Altman, asking one very, very easy question, not getting an answer, just getting attacked. That might have been the peak, or at least the short-term peak. And then the market started to ask way more questions because, of course, as stocks come down crashing, well, the headlines keep on increasing. Right? The headlines keep on increasing. You then also have Michael Burry, the broken clock, came out with a short on Palantir and on Nvidia as well. So all of that together is what led us to this video and this moment right now, where a lot of the high-flying names have come tumbling down since the start of October, mid-October, or some of them just the start of November. Down 20%, 30%, all the way to down 70%. We've covered that in a live stream, right? Some of these high-flying names are down significantly over the past month or so. Now, usually these corrections happen over a long-term period. What we've been seeing over the past, especially I would say 12 months or so, are flash crashes, are corrections that happen in a week or two, and then we recover. We've seen that in February or late January, maybe beginning of February, the DeepSeek drama. Remember, a name like Nebius went down 38% or so in a day. Nvidia was down God knows how much also in a day. Then we've had April, the April crash. Huge correction in the market. Huge correction in the market. Also, quick recovery. In the short term, those things aren't great because you're feeling extreme pain in a short period of time. But just like when you rip off a Band-Aid, it's very painful for 2 seconds, 3 seconds, but then it's over. But if I rip your Band-Aid very, very slowly, right? Every second's an extra inch. That pain is going to be, well, not for 2 seconds, it's going to last a minute. And me personally, I'd rather you just rip it off, it's painful for 2 seconds, and we move on. Same with the market here. Market doesn't like it, okay, crash everything in a week or two, and we move on. To me, it's much better. Yes, it does create those extreme volatile moves. I know. But I'd rather see this than a 12-month bear market. Now, another thing that was interesting is that on Friday, actually for the last 2 Fridays, we've seen the S&P drop below the 50-day moving average and then close out the day back above it. For the Nasdaq, well, the Nasdaq is actually about the same thing, right? If we look at the Nasdaq 100, same thing here. Last Friday, we've seen it drop a little bit below the 50-day moving average, recovered, closed above it. This Friday, we've seen it go under quite a lot more, under the 50-day, also closed above it. Is it a dead cat bounce, or is it maybe the sign of, okay, we might see a recovery pretty soon? I don't have a crystal ball, unfortunately, otherwise I would have given you all the answers in a second. But what I do know is that next week we have Nvidia that reports their quarterly figures on Wednesday. And of course, Nvidia sits at the center of this whole AI bull market, right? Nvidia as well has seen its stock go under the 50-day moving average this Friday and the one before it. Guess what? It went under and it closed above the 50-day moving average. We've seen quite a lot of stocks do same thing. Actually, with Intel, I believe Intel touched the 50-day moving average and then it went above it. If we look at Friday, voila, Intel touched the 50-day, closed above it. Then we have some other names that were not so successful, right? One of the neo clouds out there, Nebius, 100-day moving average, went below it. Intraday did recover, but we closed just under that. We are now filling that Microsoft deal gap slowly and slowly. Will it go all the way back down? Remains to be seen. To me, the next stop is probably going to be around $75 or so. And then we have Dlocal, which is a name that we will cover in this video. Same with Transmedics, same with Pagaya, and then another one. So Dlocal, same thing here. Stock touched the 100-day moving average, did not go under it, but stayed above it, did recover a little bit. Dlocal is a company that is small, $4 billion in market cap, cheap in my opinion, profitable, reported a good quarter. Yes, there was maybe one thing that the market didn't like, and so the stock did drop, but luckily for us, before they reported, stock did go up for 4 consecutive days, so we're basically at the same prices we've seen last Friday or start of Monday. And so if you enjoy this type of videos, hit all the buttons, would really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much, and a special thanks to Fiscal.ai, previously FinChat, for sponsoring this video. Everything, every metric, every transcript that you're going to see comes from this platform right here. If you use my link, you'll get 15% off. It's in the description and in the pinned comment. So Dlocal, $4 billion of a company, year to date still up 17.1%, trailing PE of 24.5 times, forward PE of 17.3 times, still expected to grow revenue and EPS quite quickly over the next 2 years. Margin-wise, it's also not bad of a company, especially not one that is this small, still growing quite quickly. Yes, I know. You have to understand that this is a company that is, yes, in the payments market, but specifically the global south, so emerging markets, which are, yes, which are riskier than operating, let's say, in just North America or something like that. You have emerging markets, you have fluctuations in currencies, and maybe some economies there are not that stable. So all of that does impact a company like Dlocal. But it is a huge, huge market. And again, this is just a $4 billion company at the moment. And so what went wrong, you might ask? Well, I'll start with what went right, and that's this here, TPV. TPV is a very important metric. TPV is total payment volume. You can see that this one increased 59.5% year over year, now above $10.3 billion in just 1 quarter. Now, what went, let's say, wrong, or what still continues to go in the same direction as to what management has told us, and that's take rate. And in this case, take rate went down from 1.07% in Q2 to 0.99. But there is here a what they call sort of a one-time bigger impact from the others category here, 0.04%. If you remove that, it would still be a decline, but a smaller one. And again, they keep repeating the same thing time and time again. Net take rates are still expected to come down slowly, but they believe they can make up that impact by just increasing TPV much more. I've seen people talk about this, and a lot of people are correct, right? Will people still be looking at net take rates coming down slowly if TPV is at $100 billion in a couple of years or more? Probably not. Probably not, right? And Adyen has a net take rate way lower than Dlocal. Of course, Adyen's TPV is multiples times bigger than Dlocal. But still, did the market only look at net take rate for Adyen, or were they looking at other metrics for the business? In my opinion, they were looking at other metrics for the business. Now, that's not all. The other thing was gross profit. So gross profit still increased nicely year over year, but only 4% quarter over quarter, and gross profit margin did come down a little bit. Now, they said the following thing: that was partially offset by Egypt and temporary margin pressure in Argentina and Mexico. With Egypt, this is again something that they mentioned the quarter before. One big advertising merchant, we're speculating if that's not maybe Meta, we don't know, But one big advertising merchant has basically, well, slowed down all of their investments, and that does impact a company like Dlocal. Again, a small company, big market, but if you have one big merchant in that specific market that starts to spend a little bit less, you're getting impacted by that. Now, going back to what went well is this. If you look at buy now, pay later, 2.5x volume growth quarter over quarter. It's now live in 6 countries across Latin America, Africa, Middle East, and Asia. This is a revenue share model, so there's no credit risk taken by Dlocal. That's not all. They also told us the following things specifically with regards to buy now, pay later, and that's that they expect buy now, pay later that's growing faster than overall market expected 20% compound annual growth rate between 24 and 2027. Then as for guidance, and yes, during the live stream, I was quite confused because last quarter guidance was raised, but I was still confused by where these light blue rectangles were put. They were still put on the old guidance, despite them raising guidance. So it was quite confusing. So in my head, it was, oh, they actually reduced guidance a little bit. But no, they're not telling us where they think they will land on the updated guidance, which is still very good because TPV still expected, were now expected to be above the upper range of their guidance. So above 50% year over year. Revenue around 40% year over year growth. Gross profit around mid, so 32.5% year over year growth, and adjusted EBITDA also around mid, 45% year over year growth. Now, the key risks here are not something that they expect to happen, just something that you need to take into consideration, things that might affect guidance. One last thing here, and that's with the weakness in Egypt. They did say that they've seen some volume recovery that began in October, which could help with the upcoming quarter or quarters, if of course that recovery does continue in November and December. And so to me, Dlocal, easy pickup. Moving on to company number 2, and that's Transmedics. Transmedics is also a company that is trading around $4 billion in market cap. Here the PE is a bit higher, but this is also a fast growing company. Trailing PE 45.4 times, forward 43.1, but the PEG ratio is at 0.3 at the moment. This is a company that's also expected to grow revenue quite rapidly over the next coming 2 fiscal years, although growth rates are coming down a little bit, but that's not the whole story. EPS is expected to grow 72.9% compounded over the next 2 fiscal years. This is a company that is still up 72.9% year to date, but as you can see recently, it is experiencing a small drawdown. Now, this is also a company that reported earnings not that long ago. Good earnings report. Stock should have reacted, did react positively, but the whole market went down, so it takes down these types of names as well. And so, as you can see, this is a company that has been growing very, very quickly over the last couple of years. Yes, you can also see that the September quarter is a quarter that gets hit by seasonality, because that's one where you can see a drop quarter over quarter, still increasing revenue 32.2% year over year. If we look at the expected growth for this fiscal year, that's 35.7%, and then only 19.4% in fiscal 26 and 16.8% in fiscal 27. In my opinion, these growth rates are quite low, especially since they are now trying to grow, they are going to grow in Italy and expanding internationally further into Europe. This is a company that generates revenue through service revenue and net product revenue, which is the one that is here the biggest one. When you look at margins, gross profit margins is around 60% over the last 12 months. If you look at operating margin, that sits at 16.9%. Now, last quarter, these were the numbers. Let me actually move myself right here. You can see the following thing. Product revenue increased year over year, same with services, but both of them again down quarter over quarter. Q3, seasonally weak quarter. Owned aircraft, 21 for a quarter, but it's already at 22. Net income did increase by $20.1 million year over year, but is down 10.6 million quarter over quarter. Gross margin up 2.9 percentage points year over year, but down 2.6 quarter over quarter. And then operating margin up 12.6% year over year, but down 7% quarter over quarter. If you look at the overall picture of this company, this is a company that is doing exactly what it should be doing. That's growing, becoming much, much bigger. See margins here, operating margin year over year. That's up. Gross profit margin, that's up. Year to date, you can see a lot of good things as well. Don't just focus on what happens one specific quarter, especially a seasonally weak one. They've also updated their own guidance. They're now expecting to grow revenue approximately at 36% year over year at the midpoint, continued increase of organ utilization and OCS adoption. That's basically their assumption. Now, Singularity Research here is tracking the amount of flights that Transmedics is doing. They did 28 flights and grossed $1.9 million, estimated number, over the last 24 hours, which was yesterday on Friday. They are on track to do 2,256 flights and gross $153.4 million, again, a rough estimate, this quarter, which would be the higher end, if not beating the guidance for Q4. And as you can see, since after Transmedics reported, stock is down from the peak 18.2%. Is the company suddenly 18.2% worse today than before? Or again, is this macro? My opinion, this is macro. It has nothing to do with the company. The company is doing what it should be doing. And if it does reach their targets of 20,000 transplants by 2030, then this company, of course, will be much, much bigger than the $4 billion that it's trading at right now. Of course, you need a long-term vision for this company. You need to follow that company. But right now, the metrics show that this is one that is going up and to the right. Moving on to the next name, and that's also a name trading at around $4.8 billion. That's Shift4. Shift4 year to date is down 35.5%. This is a very profitable company, also a cheap one. Trading PE 32.5 times, PEG ratio of 1, revenue growth 25.1% CAGR for the next 2 years. If you look at EPS, expected to grow faster than that. If they reach their free cash flow goals for 2027, $1 billion, trading at $4.8 billion in market cap. It's really not that much. Yes, it does have an enterprise value of $9.6 billion. Why is that? Just look at the net debt here of $3.2 billion. Am I worried by this? No, at least not now. More recently, they attended the KBW FinTech Payment Conference. Yes, a lot of companies are going to these conferences after they reported their quarterly figures. So what did they reaffirm? Medium-term guidance targeting $1 billion adjusted free cash flow exit rate by 2027. They, of course, authorized $1 billion repurchase program, doubling the size of the prior one, which is also, in my opinion, why the stock did go up a little bit after it dropped over the last couple of days. Global Blue's revenue grew 19% year over year, with global sales in stores up 5%. Organic growth is tracking to 18%. They achieved a high 40% adjusted free cash flow conversion rate in the quarter. If we go and look at the last quarter, again, all of this is available to you on fiscal.ai. We can look at the following thing. Last quarter, volume increased by 23%, gross profit 62%, gross revenue less network fees 61%, diluted EPS on a GAAP basis 17 cents, net income $33.4 million. Again, that's not all. This is a company that despite being very cheap by the market, also with a high short interest, I still don't understand why, they're executing, and they've been executing actually for many, many years now. Yes, this is a company that does like to acquire other companies. Some people don't like it because they think that at one point there might not be any companies to acquire anymore, and that will stop the growth here for Shift4. I just think that's absurd. Right? I don't think there will be a lack of companies in the future. Plus, as this company grows and does integrate all of the acquired companies, it becomes more efficient. They are deleting parts. It has a better offering, right? They can cross-sell to many, many of their customers. They're now available in 6 continents around the globe. So I just don't believe the bear thesis at the moment. Another thing to note here is that one, they're the number 2 in the restaurants in the United States. Number 1 is Toast, the company, not the number 1 player is Toast, meaning they're screwed. Number 1 in hospitality in the United States, number 1 in sports and entertainment in the United States, and number 1 in luxury retail globally. You know, next year there is the World Cup in the United States. I think it's quite a good thing that we are the number one in hospitality in the United States and the number one in sports and entertainment in the United States when there is a World Cup on the horizon. If we look at Shift 4 stock, it did go under that uptrend line that started all the way back here, July 2022, did recover, and right now we are trying to stay close to that previous bottom right here. The previous bottom right here was the bottom in April. To me, this is a cheap company, one of those that I will keep accumulating and grow the amount of shares that I own. Lastly, there is Pagaya. Now, Pagaya is a company that I had call options for January. They were deep in the red, and I decided to basically convert them into shares, what was left of those call options, the $30 and the $40 strike price for January. And so Pagaya, as you can see, is also here at the 200-day moving average, and on Friday we did see it go up 2.2%. Pagaya is a company that reported earnings a couple of days ago. You can see that after they reported earnings, stock went up 15-18% or so, although closed the day up only 13%. And then after that, we can see that the stock fully retraced to the price not seen since before they reported a great quarter. Now, for those that don't know, Pagaya is a very small company. It's a company worth just under $2 billion, but it's one that is, of course, outperforming this year by quite a lot. It's up 148% year to date. But it is a company that is still expected to grow nicely, revenue and EPS, especially EPS, compounded growth over the next 2 years. It's a company that is becoming more and more profitable and, well, continues to grow. Now, what was the problem? Why did it drop since the peak in September? Was it company related, or was it again sector related, or maybe another company in that sector that was quite weak? Well, yes, it is sector related, and it's also because of some other companies that try to do the exact same thing that don't really put up the numbers that they need. But Pagaya, as you can see, last quarter, network revenue increased 19%, total revenue 36%, revenue from fees 36%, production cost was also up 35%, fee revenue less production cost increased 39%, core operating expenses dropped 11%, net income for the quarter, not a net loss, adjusted net income increased 180%, and adjusted EBITDA increased 91%. This slide, again, says it all. Every time we hear an analyst talk about maybe one of competitors or something that is not going in the right direction, just look at this chart. This is going up and to the right, and becoming profitable. This is a good business, small business, but yes, there are, let's say, some fears, especially when it comes to credit. Now, talking about credit, the company told us the following thing. Management described macroeconomic trends and overall consumer behavior as healthy and stable. This stability is attributed to a balanced and conservative underwriting approach adopted since the beginning of the year. This strategy positioned the company with a needed cushion against market volatility. The company's B2B business model, which focuses on partner and product expansion, and by the way, the partner pipeline is growing. They've also signed a large regional bank in the United States. So all in all, again, good commentary, good quarter. I'll continue here. So their B2B business model, which focuses on a partner and product expansion rather than aggressive marketing tied to high approval rates, helped to mute the impact of broad consumer credit behavior changes compared to traditional B2C lenders. The most impactful financial metrics show that the strategic decision to tighten credit standards is paying off dramatically. Cumulative net losses for 2024 quarterly vintages are trending 35 to 40% lower than the peak that they've seen in Q4 2021. Cumulative net losses for 2024 vintages are trending 50 to 65% lower than comparable periods in 2022 for auto loans, and point of sales credit trends also remain stable and consistent, supported by robust investor demand for these assets. And this, of course, is a company that is extremely picky when it comes to the applications, right? If you look at the $266 billion applications evaluated in Q3, that's up 12% quarter over quarter, they have approximately a 1% conversion rate, right? Conversion rate of applications to issued loans in Q3. You might say, oh, that's just very, very small. If they are so good at what they're doing, shouldn't that be higher? And maybe it will be higher in the future, but right now, this also allows them to be in a better position in a, let's say, market that still has quite a lot of uncertainties. And me personally, I rather them, yes, stick with this right now to only accept quality instead of, okay, we're increasing it, but then the quality of these loans do come down, and that will essentially also hurt the overall business. And then, yes, and then maybe everything does come crashing down for a company like Pagaya. And so all in all, that's about it for me in this video. 4 companies, small market caps, but in my opinion, great companies, good businesses that are trading at very, very attractive prices. The next video will focus on, let's say, bigger companies. So stay tuned for that. Hit all the buttons. Do check fiscal.ai down in the description and in the pinned comment. You get 15% off. New users will get 2 weeks of Fiscal Pro for free. See you all in the next one. Bye-bye.